All right, Yield Nerds, episode 162, and I am terrified as I sit there. The yield bear has indeed woken up, and it is steepening, and I am looking out for myself. That, and I also got severely damaged by the tax bear, and I'm going to tell you what mistake I did. And yes, it is a mistake. Right about this time, if we were a high budget operation, I would put eerie bear music, but we are a low budget operation. So imagine the yield bear getting you, and I'll tell you more about how it got me. We're at 460 something subscribers. Thank you for your support. We have 3 playlists. Feel free to look through them. And most importantly, anything you hear from here, you have to do your own research and make your own decisions. So please remember to do that. Well, 4 parts today. The first is I will tell you all about this yield bear, and then I will tell you about the tax bear that got me. It really annoyed the hell out of me, and I want to share my mistake and tell you what it is, so maybe you can avoid it yourself for the next year if maybe you made it the same way I did last year. And I will share my investment thesis, including some stocks that I'm looking at very seriously. And finally, my holdings. Well, my entire portfolio remains the same as before. It's kind of crawling up. It doesn't really react to the market. The market goes up and down and nutty, and mine stays flat. My equity portfolio also reacts in the same shape as the overall market, except the intensity is far lower. And so, I get about a third of the downside of the market on that equity portfolio, but I also get almost all of the upside, which helps. Finally, the reason I can do this is because my allocation, pardon me, continues to be minuscule to the equity side of the house. I am still very heavily fixed income, and I'm kind of cheering as the yield bear creeps up on the long tail. However, that yield bear is dangerous, and I have to watch out, and I'll tell you more about it pretty soon. Well, you may remember the end of March and the beginning of April, we saw the yield cup, and I said this is uncharted territory. Last week was even more uncharted. Check this out. The previous 2 weeks looked like that yield cup. This time there was a true bear steepening, wherein the rest of the curve went down and the long end, the 10-year, shot up. And that is the classic bear steepening as it is described. And it is not indicative of stability in the treasury market, which is a very scary thought. Well, the press, of course, took it and ran with it. I'll post links to all of these on the description. Bloomberg wrote an article about there is an exodus from US assets. That's because there is a lot more sales of the 10-year than purchase of the 10-year, and that drives down the price of the 10-year, which means it drives up the yield of the 10-year, and that is why there is bear steepening. And there is more doom and gloom. Oh my God, who is going to buy the surge of treasuries? That is going to happen because we have a really big debt load. And when that debt comes, if there isn't enough demand, then the price will go down and the yield will go up. And I am ready for that high yield treasuries. I believe in America. I will buy the 10-year yield, the 10-year treasury if the yield indeed is north of 5%. Having said that, you may remember in the previous episode, if you haven't watched it, I suggest you watch it. We talked about how bear steepening is indeed one of the possibilities. I called it path 2, where there is fear of excess debt. And literally 3 days after this episode, that exact phenomenon happens. And the fear of excess debt and the potential of default and lower demand is fueling that bear steepening. And on the one hand, you can say, hey, maybe I can get higher long-term yields. However, the dollar will get damaged, and depending on what you buy, if what you buy comes from the export market with the dollar weakening, then it is going to really hurt you. If you make something that you export, you may be better off. But overall, this may be good for yields for a yield nerd. However, for the country, it's not exactly the right message. Having said that, let me share where I got attacked by the tax bear. And here is the tax bear sitting on top of me, weighing me down. I'm smiling, but it actually is not a good experience. Before I go further, I want to remind you yet again that I'm not a wealth management advisor. And what I'm about to share is neither tax advice nor investment advice. I'm sharing my knowledge, and please do your own homework. Well, the reason I'm sharing this is, as you can see, my fantastic returns got a really ugly jolt. I had to sell some of my treasury positions to generate cash to go pay Uncle Sam. And that is because I really underestimated my taxes and I paid far less in estimated taxes than the actual. And so it irritated me, and I tried to figure out how did it happen. So here is some basics, and then if you're not familiar with these basics, I would once again suggest you watch some of the older episodes of Yield Nerd. Treasuries are not state taxable. We all know that. If you buy a treasury at, let's say you buy a T-bill, meaning less than 1 year in duration, at $99, over a period of time, it is going to go to 100. In that scenario, in 3 months, it goes to 100. Well, what is the difference between 99 and 100? Is it income? Well, you could argue, well, it's income in the sense that I put it into my bank account. However, it is not income. It is a gain. Your brokerage would classify it as a gain. And so I wanted to go see where that $1 shows up. And here is the very, very interesting thing. I went to this section within Schwab called investment income, hoping to find that equivalent of that $1 there. It was not there. So if you use last year's investment income to estimate what you think your taxes will be for this year, oopsie daisy, you completely did not see that $99 becoming $100 on the T-bill. And so you go, okay, well, if it is not that, if it is not investment income, maybe it's gain. I know it's gain. Let me go look for it in realized gain. Well, here is my actual realized gain for this year. And as you can see, the gain is 0.00000, except this time that I had to sell these T-bills before they matured. And I never ever do that because I like holding my T-bills to maturity and make the full yield. But I was punished severely, and I had to sell some T-bills, take the gain, which really is not a gain. So this is in that scenario, this is the 99 cents. And here it is growing up to 100 cents, and it's kind of sort of in that 1% range. Maybe I bought it for 98 cents, and it's coming towards 99.5 cents, and I sold it before it matured. But that is the only scenario where you book a gain on your treasury. In all other cases on Schwab, that difference between 99 and 100 is not a gain. If it is not income and it is not gain, what is it? And where can you find it? It's really irritated me because I used my last year's income to estimate my estimated taxes and I was way off. Well, it turns out you have to look at your tax statements on Schwab. So if you go to your tax statement and if you download the statement as of the end of each quarter, on page 2, you will see a little table like this on the bottom right on page 2, and it tells you what all your income is, and this will not match your investment income because treasury bill interest is not investment income. It's really a gain that is classified as bill interest, which is the most annoying thing ever. So I did not account for my treasury bill interest in my estimated taxes. And you know that I hold a large chunk of treasury bills on my portfolio allocation. And so I got walloped with an estimated tax, with the real tax, because my estimated tax were lower. So my moral of the story is the following. Do not fall into the same trap I did. I don't intend to for next year. As a matter of fact, if you were to open that statement and you were to search for treasury bill interest, next to every treasury that matured in that statement period, Schwab will show you how much treasury bill interest there is. Now, you cannot see it real time. You cannot see a table of all the T-bills that matured and what you made for each one of those. You have to dig through the statement. Schwab, you disappointed me. And no wonder I did not pick this up. So the more T-bills you own as a percentage of your portfolio, the more, at least I did, the more I was likely to have completely ignored the tax impact of the 99 going to 100. So I missed the boat. I learned. I'm sharing my knowledge. You do you. So here is what I intend to do now. I intend to take the previous year's effective tax rate And every quarter, at the end of the quarter, I will look at Schwab, and instead of looking at investment income, which I cannot look, I now have to go to the statement and look at total income, which is investment income plus treasury bill interest. And that is what I need to multiply by my effective tax rate to get the new estimated tax. Remember, you are not using, at least I will not be using marginal tax rate. I will be using effective tax rate. What is effective tax rate? You take the total tax paid and you divide it by taxable income, and that as a percentage is your effective tax rate. Your marginal tax will always be the tax on your last dollar. And those of you who buy muni bonds and say, oh, it's tax exempt, and I saved marginal tax times, coupon, you do you. I don't believe in that theory. So effective tax is what I would use if I were to estimate estimated taxes. So that is how I plan to do it. Well, what does all of this mean to my investment thesis, the bear steepening and everything else going on? I go back to my potent tanker opinion, which I did talk to you about. The link to this is also in the description. This shows a really nutty chart. The red line here is the spot price of West Texas Intermediate crude. And as you can see, the spot price kept going high, reached 100, and it has been dropping ever since. And actually, it has now reached $60 a barrel, which is pretty nutty. And as the price of oil drops, the irony is the volume of oil that is being pumped out is increasing. And so that is accelerating the drop of the price. So what do you think is going to happen? Any reasonable business will see declining profitability and slowly start decreasing volume, unless, of course, you can find new buyers. Then you have to ask the question, where does this oil go to? And a large amount of oil goes to Canada, and you know the whole tariff situation there. A small amount of oil goes to South Korea, Netherlands, Japan. So these are the countries where these tiny bars go to. And here is some nugget from that same opinion. The estimate is that some of these countries, as a way to make a deal to decrease tariffs, will start buying more American oil. And if they do that, the price of oil will stabilize instead of dropping all along. And if the price of oil stabilizes, then oil stocks should increase. Instead of buying oil producers, what I'm planning to do is buy oil pipelines. And I've actually bought a bunch of them, and I intend to buy more of them. So my bets on my thesis are in stocks to start looking at pipelines, which are highly depressed right now because there is a big prediction that the volume is going to decrease. I am going to swim against the current and say volume is not going to decrease. There will be new customers for the existing volume. And when that happens, then the pipeline stocks will appreciate, and I want to benefit from that. Unfortunately, I don't believe in world peace, so I'm sitting on a lot of military defense war stocks. So pretty much my picks are higher oil per barrel and war, but remember, this is only 1% of my portfolio. And I am digging into soybeans and corn. These are in all-time lows, almost 5-year lows, as though we are in the middle of COVID. And that's interesting to me because one of the possible deals as we get out of this tariff situation is also that there will be more soybeans and corn that will be consumed by other countries. And when that happens, this 5-year chart may reverse. And so that is my thesis. Other than that, I am just as terrified as the steepening yield bear. I'm still going to stay in the short end. My holdings pretty much are still in the extremely short treasury side of the house. And, I do have some agency bonds and some investment grade bonds, but my stocks are all in higher oil price and war. Thank you for listening to Yield Nerd. And I hope your journey in investing is as exciting and as educational as mine. And I really appreciate all of your comments. And you can see that in the short run, I'm in treasury, medium in agency, long in corporate. And please do your own research and have a wonderful week.